Hey, this is Jules. I am just recording a little bit of a lesson on basic options, and I'm going to go into a little bit about butterflies. When picking an option strike, there are three kinds: in the money, at the money, and out of the money. If the stock is a $40 stock and out of the money is a $45 strike, at the money is a $40 strike, and in the money is $35. If you're buying puts and the stock is trading at $100, out of the money is $80, at the money is $100, and in the money is $130. In the money options are the most expensive and move the fastest. Out of the money options are the cheaper but can be more risky because you need a bigger move in the stock price for the option to move higher. At the money are slightly cheaper than in the money and move just a little slower. There are three factors for buying an option. 1, time frame. 2, price for the option. And 3, a strike price. If the call options expire in the money, this means the strike price is below the stock price. 1, the buyer can exercise the option of the shares of stock. 2, or the seller the option back for a profit. 3, very important at the end of the day, whenever you have calls, puts, a butterfly, vertical spreads, anything, to make sure you close them out if they're in the money so that you don't get exercised and assign shares that you don't want. A put option is just the opposite. The buyer has the right to sell 100 shares at expiration. When choosing a strike price, key factors involved are liquidity and volume, in the money, best for buys, out of the money are best for sellers, but all depends on your time frame and where you think the stock is going. The difference in the spread between the bid and the ask, and probability of in the money or at the money. Most brokers have tools that can help you chart this. Time decay. When someone buys an option, they are buying the time they think it can take for the stock to reach a certain price. The option will lose value the closer you get to expiration because the stock price is more certain than when you picked the option. Value. A call locks in value as the stock price goes up. When in puts, it locks in value as the stock price falls. Implied volatility is determined by the current price of an option contract on a particular stock or futures. Options are insurance contracts, and when the future becomes uncertain, there is more demand for insurance on that asset. This means that a stock option will become more expensive as market participants become more uncertain about the stock's performance in the future. When the uncertainty of a stock increases, the option prices are traded to a higher price, which increases IV. When fears diminish, the opposite happens and the option price decreases, which causes the IV to decrease. When implied volatility is high, it is a great time to sell covered calls because this is a lot of premium to collect. Let's talk about butterflies. A butterfly spread is a neutral strategy that is a combination of a bull spread and a bear spread. It has limited profits, but also limited risks. There are 3 strike prices involved in a butterfly and can be either calls or puts. Using calls, a butterfly is done by buying 1 long call in the money, selling 2 at the money calls, and buying 1 out of the money call. An example of a butterfly when the stock is trading at $40 now in January would be to buy $30 calls at $12, sell 2 $40 calls at $5, and buy 1 $50 call at $1. Maximum profit is when the stock price remains unchanged at expiration. If you are doing an in-the-money call, the maximum profit is to the stock price of a short call minus the price of the lower strike price of a long call. I'll go over this at the end. Max profits achieved when the underlying stock price is at the price of the middle call, the short call. If the stock closes at $40 at expiration, the $40 and the $50 calls will be worthless. The $30 call is worth $12, so you subtract what you paid for the butterfly, which is $12 for the $30 calls, plus $100 for the $50 calls, minus $1,000, which is 2 legs of the $40 calls, and this is equal to $300. So this is what you paid for it. So you minus that from the $1,200, and you have a $700 profit. Butterfly trades are generally slow moving at the beginning of a trade and only get exciting towards expiration. Butterfly options have a 10-to-1 risk reward, which is very good for options. Longer-term butterfly is a good way to hedge your stock positions without having to put up a lot of capital. Greeks are important in any kind of options you're trading, whether it's longs, shorts, bear spreads, vertical spreads, bull spreads, any kind of options. The delta measures the price movement of an option contract in relation to $1 move in the security. An option doesn't move dollar for dollar with the underlying security. By using the delta, you can see the price movement between the option contract and the security. Theta measures the time decay of an option contract. Time decay happens per day. The rate of theta increases as we approach expiration. Theta is 0 at expiration. Implied volatility is the price movement of an option. The marketplace implies what the volatility of a stock will be in the future and what effect it will have on that price. Butterflies are made up of a vertical spread and a credit spread. So at or near expiration, if several legs of the option are doing well, you can always sell the leg that isn't doing okay and hold on to the other ones. Butterflies are so diverse. There are long call butterflies, short call butterflies, same on the put side. There are something also called an open call butterfly or an open put butterfly. This is where you have a butterfly, say you're trading NVIDIA, and you have a 150, 160, 170 call butterfly. The short leg has 2. If the stock is trading around 145 and starts moving up so that you feel that the stock is going to go above the 160, which is your pinpoint in the middle, you can always buy back half of the short leg, which is the 160 leg. So when it is moving, the long legs become more profitable. So when you feel the stock has reached a peak, you can sell back the 160 leg, and the option of the butterfly will become more profitable at expiration. Butterflies can be a great way to play earnings. You don't have to invest a lot of money, but you can be profitable. Best to try to find good support or good resistance areas to try to pin the short leg of a butterfly. Butterflies are usually done on the call side by buying one in the money call, buying one out of the money call, and selling 2 at the money calls. If doing puts, you're buying one out of the money put, buying one in the money put, and buying 2 out of the money, selling 2 out of the money puts. Long butterfly. Max loss on this is the amount you paid for the butterfly. The max profit is the difference between the 2 long calls minus the price you paid. Example, 150, 155, 160 long butterfly, you paid $2. You take the difference between the 150 and 155 strike, which is $5, and this gets multiplied by 100, number of shares in one contract. So that's 5 times 100, which is 500. You minus $2, what you paid for the option, 300 is your max profit. If you're doing a short butterfly, or basically the opposite, if you short a 150, 155, 160 butterfly and you collect the $2, that's your max profit. However, your max loss is calculated the same. The $5 difference in strike, so 5 times 100 equals 500 minus the $2 that you collected equals 300. This is your max loss. So it is the opposite of a long butterfly. Butterflies are a great way to make money if you are playing earnings and looking for a stock to pin a specific price. Also, butterflies are a great way to hedge if you own stock and you're not sure where it's going in the future and you want to place something maybe 3 months out. You can buy calls and puts on butterflies for a really cheap price. So much better than just buying long calls or long puts where you can really get killed on. Any questions, just let me know. Have a great weekend, everyone.